Hello, and welcome to the BioSyent Inc. Q3 2015 results presentation. My name is Rene Gorham. I'm the Chairman and CEO of BioSyent. I want to start today's presentation with a review of our revenue numbers for the quarter and 9 months ended September 30th. As you can see, our revenue for the quarter reached just over 4.6 million, which represented a 28% increase from 3.6 million in the third quarter of 2014. And for the 9 months ended September 30th, sales reached a little over $11.5 million, which was a 26% increase over the 2014 9-month period. The key drivers of growth for the business in the third quarter were primarily pharmaceutical. We had our second consecutive record quarter for pharmaceutical shipments. That included a record month in August. Our total pharma sales increased 22% in the third quarter versus the second quarter of 15, so that was sequential growth of 22%. And these were driven by really FeraMAX, Cathogel, RepaGyn, and our international business. So the FeraMAX 150 in Canada had its second consecutive record quarter. We did an IMS poll of data to look at the January through August units, and although that doesn't correspond exactly with the period ending September 30th, you can see that our share of doses, so the total doses in the market, our share grew 19% in the 8 months ending August of 15 versus the 2014 period. Our Cathogel business saw sales increase by 48% in the quarter versus Q3 of 14, and Cathogel is now used in over 220 hospitals in Canada. That represented a 12% increase in the third quarter versus the second quarter of 2015, so once again sequential growth. Finally, in Canada, we had a record quarter for RepaGyn, although the sales are still modest. Importantly, we've had a steady increase in units reaching back into the first quarter of this year on a compound basis, growing in the 11-12% month over month. Unit sales for Q3 were 44% ahead of Q2 2015. Comparison to a year ago for RepaGyn isn't really applicable, as we just launched the product at the very end of Q2 in 2014. And then finally, as a driver in the business for the quarter, we had a record quarter for the international business, so that'd be international sales of FeraMAX, both FeraMAX 150 and FeraMAX powder, and we're on track to more than double our international FeraMAX business in fiscal 2015 versus 2014. During the quarter, we appointed a new Vice President of Corporate Development to both enhance and accelerate the sourcing of new product opportunities. Of course, we announced something I'll go into more detail, a new product in-licensing deal in August. That was really unrelated to this new hire. The SIS View product was licensed on an exclusive basis for sale and distribution in Canada. It's a patented technology that aids in the diagnosis and management of bladder cancers. It's successfully marketed in the US. It's been in Europe since 2006. It was approved by Health Canada in January of 2015. Our read of the potential in looking at the penetration they've reached, primarily looking at the European model, as the funding would be similar to that in Canada. It should deliver in the 4 to 6 million range of revenue at peak penetration. This would certainly take a few years to get to that run rate. Subsequent to the end of the quarter, we successfully transferred the SIS View marketing authorization from our partner Photocure, a Norwegian company, to BioSyent Pharma, and we're now preparing to launch SIS View to Canadian customers in the fourth quarter. I want to take a look at our pharmaceutical sales by quarter over the last 20 quarters, so over the last 5 years. We show this slide on a quarterly basis just to show how our pharma business is evolving. You can see that Q3 of 2015 versus Q3 of 2014, the pharma business was up 32% and had a significant spike in the quarter, some of that obviously driven by the international business. Looking at our earnings before interest, tax, depreciation, and amortization, EBITDA, for the quarter and the 9 months. So in the quarter, we had EBITDA of a little over 1.6 million. That was a 20% increase over the year ago quarter. And for the 9 months ending September 30th, EBITDA was at just over 4.1 million, a 27% increase versus a little over 3.2 million a year ago. You can see, looking back on this chart, that we show the evolution of the business from 2012 through 2015, and you can see that for the 9-month period, and for the quarter for that matter, we've increased our EBITDA by a factor of 4x over this period of time. On a net income after tax basis for the quarter and the 9 months, in the quarter we reached just under $1.2 million of net income after tax. That was up 19% from the year ago period of just over $1 million. For the 9 months, we were just over $3 million, and that was 25% ahead of the year ago 9-month period. When you're looking at this chart back into 2013 and 2012, one thing to point out is that we had no tax expense in Q3 and YTD of 2012. We started expensing tax in the fourth quarter of 2012, and so this really becomes an apples to apples comparison when you look at 2013 and onwards. Quick review of our balance sheet. A couple things that I'd like to point out today. One is that our cash position, cash equivalents and short-term investments moved from June 30th, a little under 7.5 million to just under 8.4 million on September 30th. That includes the investment in the SIS View license, which was converted to, it was a US dollar investment converted to Canadian, just over $860,000. So that would have obviously reduced our cash position. But you'll see in the intangible asset line that intangible assets have gone up to just over $1 million, and that's largely driven by the SIS View license. Down below in long and short-term debt, you can see that we continue to be debt-free. We have an operating line of credit available to us from the Royal Bank of Canada in the amount of 1.55 million. We have as yet never used that line of credit in the conventional sense. We use it to secure foreign currency hedging operations, and you'll see when you go through our MD&A how we've been able to manage our forex expense to be significantly lower, have the impact of the depreciation of the Canadian dollar significantly lower through our hedging activities. Total equity moved to just over $11.3 million as of September 30th, and you can see that move was quite positive to the December 31 number, so 9 months ago, of a little over 8.1 million. Total working capital is up 28% in the 9-month period ending September 30th. We wanted to take a little bit of time to talk about our gross margins. If you are an investor or a frequent follower of this quarterly report, you'll know that we're primarily an importer. While most of our purchasing is not done in Canadian dollars, certainly our purchasing on cost of goods comes from partners and manufacturers in the United States and in Europe, is done in the form of USD and Euro. And as a net importer, as the Canadian dollar has deteriorated in value over the last 15 months or so, maybe even longer, it would have an impact on our business. I mentioned on the previous slide that we have been active in the market and hedging our currency requirements and kind of reducing the impact of the move in the currency. And this slide really demonstrates our ability to maintain fairly consistent gross margins in 2015 versus 2014 despite the downward foreign exchange pressure. So for the quarter, our margin remained at 77% compared to the year ago quarter, and for the 9-month period our margin remained at 78% for the 9 months compared to the year ago period. Despite the downward move by the Canadian dollar, we've been able to hold our gross margins through hedging. The other thing that will affect margins over time might be product mix. Not all products have the same gross profit margin, And of course, we're managing multiple products now to arrive at a mixed gross margin. But for the most part, margin moves that we see, we might see some margin coming off in out years. We have just gone through a planning process for 2016 and have all of our euro requirements in place that would take us out into Q1 of 2017, and have already hedged ourselves to the end of 2016 on the USD at rates that are certainly more favorable than the current Canadian dollar USD exchange. So I want to talk a little bit about our operating expenses, and wanted to leave you with a key message that we are investing for growth. We have been a high growth company over the last several years, though we have still got substantial growth this year in the 25% range. It is not as high as it has been historically. This is a combination of factors that we've got a number of products that are in the launch phase and are just kind of gaining traction in the market. One also needs to understand the investments that we're making in our business, and that will drive further revenue growth both in the fourth quarter in 2016 and in 2017 and going out and going forward. And those are really important investments. This chart shows you in the quarter our selling and marketing expense was up 42%. That's what I call spending money in the right places. Our G&A is up 29% for the period, so both of those numbers outstripped our sales increase, though importantly our selling and marketing increase was faster than G&A increase. Taken over the course of 9 months, which really, we're going to have quarter to quarter fluctuations depending on marketing programs and investments. You can see that our selling and marketing expense line is up 38% on the year versus 13% growth in G&A, for a total blend of 26% increase in operating expenses, and that's in line with our revenue increase. We've been investing in our brands. We believe we've got significant growth opportunity both in existing brands and obviously the one that we're about to launch, that being SIS View. We have started making investments already to get SIS View ready for the market and ready to launch. I feel very positive about our growth prospects and think it's important that we invest to get our business ready for growth. Got a snapshot of our earnings per share. As you can see, on a trailing 12-month basis, our EPS reached 26 cents. This is a 24% increase versus the TTM trailing 12-month September 30th of 2014. At that time, we were 21 cents TTM. So a positive move from 21 to 26. You can see in the most recent quarter, that number went to 8 cents a share, fully diluted. And you can see how that's progressed. That's up a penny over Q3 2014. As I've said, we are investing for growth and positioning ourselves to continue the momentum that we have in the business. The last slide I wanted to go over in any detail is an average return on equity. This is an important measure for investors to see what kind of a return we're getting on the equity in our business. This is somewhat affected by the growth rate in the business, our equity base, and our net income after tax line. As you can see, we had some very strong ROE numbers in 2012 was I guess spectacular. That was an extraordinary year and low equity base. I think over time that ROE number, although we'd love to keep it in the 40% range, will soften out somewhat. We're pretty confident that we're going to be able to deliver well above average ROEs. In this case, you see that last year in 2014 we were at a 48%. What we show here on the slide is a trailing 12 months ending September 30th, 2015 of an ROE of 40%. I wanted to take this opportunity to thank you for your interest in our company, for your support in wanting to learn more about what we're up to. And if you do want to dig a little bit deeper, on this slide you see a number of websites. Obviously our corporate site, BioSyent.com. There's some information on public disclosure at CDAR and TMX Money, and the others are product websites where you can familiarize yourself with our products. we look forward to reporting to you in subsequent quarters our continued progress in our business. And with the momentum that we have, we're feeling good about how we're going to finish this year and what 2016 holds for us. Thanks very much.